Well, Seema, I'm going to start with you because that little RBI about wind power was not just interesting, hopefully, about the Scots and their wind power, but it's because you have also written about the green energy transition. And we talk a lot about it and how in the short term it might be inflationary on certain levels. You think it might be inflationary on more levels. Explain.
Yeah, hi. Thanks for having me on. It's more than just the basic kind of talking about energy transition and what's going to happen to energy prices. We have to think about carbon pricing. We have to think about the carbon credits that companies are receiving. That's going to be increasingly inflationary. If you just think about research and development that companies are going to have to take on as we shift to this new greener energy world, you just have to think about things like the additional costs in terms of R&D, in terms of talent. There's so many things going on, and these are not just near-term impacts just for 2022 or even just up to 2030. These are going to be long-term impacts that companies are going to have to absorb from their cost base, and that will inevitably have an impact on portfolio allocations and the way that investors are thinking about them.
Yeah, and the inflationary story as it occurs, to your point, seem a lot more broad-based than we might think. And Margie, it appears that inflation is not going anywhere. I'm looking at some research from Nordea here this morning in Europe saying they think that inflation is going to go even higher than it is now. Where do you stand on inflation, and when or where do you think the Fed may, at some point, react to it?
I think inflation will stay a bit higher. I don't think it's really sustainable. I think that ultimately we'll see inflation taper off and go down, as the Fed said. But what's more important is what the Fed thinks, not what we think as investors. And the Fed is committed to very low rates as far as we can see. So I would say it really doesn't matter how high inflation goes. They have the ability to ignore it, and I think that's what they're going to do, and be so gradual that we won't see any change in interest rates for the foreseeable future.
Yeah, it's amazing, Margie, and I want to go back to you. We're looking at bond yields. The 10-year is back under 1.5%. I mean, I guess it's good news if you're trying to buy a home or you want to refi your mortgage. But I don't think, and let's be intellectually honest, there are many people in the world who would have said at November of 2021, the world's reopening, inflation's booming, and the 10 years under 1.5. What the heck is going on?
Well, the history books would have told you that inflation would be higher and interest rates would be higher. But what's actually happened is I think the Fed realized, all central banks realized, that they actually have the power to control interest rates. They can't do it to the economy. They can't do it to the stock market. But if they throw enough money at interest rates, in fact, they can be successful. Now that they're successful and we've seen Operation Twist fail, this has not failed. They simply needed to throw billions and billions of dollars. And so I think they're going to stick with this policy and keep rates abnormally low compared to inflation, compared to economic growth than we've seen. So I think you can throw out the history books and say this is the new world that we're in, and the Fed is really not going to change.
Seema, would you agree with that point of view? I mean, that maybe low rates, if not here forever, are going to be with us for a long, long time?
So I would agree that we're going to see low rates for a long time. I think the amount of debt that there is in the world does mean that the central bank can't really hike rates too aggressively. Having said that, I don't think we're going to stay near zero for forever by any means. I actually think that towards the end of next year, central banks, including the Fed, will have no choice but to actually start the normalization process. And we have to think, central banks are also looking on to the future, right? They're not just thinking about what's going on in 2022. They're thinking about what happens in the next recession. They need to have a bit of a cushion. So once economic fundamentals are strong enough, the labor market has got to that maximum employment that they're looking for, it will be in their interest to start raising interest rates so they do have that cushion for the next downturn.
What's the greatest risk out there, Margie? I'm here in London this week, and we're talking about the energy risk, not just to Europe, but to the world with what's happening in China, even Latin America as well. If food inflation is likely to surge as fertilizer costs rise. When you look at all the risks that are out there, maybe it's cyber hacking, like Scott Minerd says. What do you think is the biggest risk right now to global growth and the markets?
Well, I think the biggest risk continues to be in the emerging markets, Latin America and in Asia, those countries tied to China. because they are all commodity-based companies with way, way, way too much debt. They haven't changed their economies. So they're the ones that are vulnerable to increases in other commodity prices, such as fuel, such as energy. So I think those areas unexpectedly weakening much more than current optimistic outlooks is the biggest risk to global growth. But I do think countries like the US and developed Europe are very, very strong and have the momentum. So I think all the risk is there in the emerging markets, once again, as we've seen in other credit crises that have developed.
Seema, I'm going to ask the same question to you. When you look out, whether it is green or clean energy inflation, whether it's fossil fuel inflation with what's going on, Vladimir Putin, what do you think is the biggest risk right now in the world?
So if we're talking about specifically 2022, we're most worried about those supply chains, right? Nothing can really move. We can't get labor participation back up until we get things moving on the COVID front, we get supply chains moving, and then inflation can start to come down. So that for us is going to be the biggest watch point. And to be honest, it's really watching what the companies are saying. What are they guiding us in terms of the real life challenges that they're facing? That if we don't start to see supply chains starting to ease up, then we should expect that inflation will stay elevated for much longer than 2022.